September 16th, 1992. George Soros wakes up a billionaire, not because he built a company or invented something, but because he bet against an entire country's currency and won. George Soros made over $1 billion in a single day by shorting the British pound. And the craziest part? He saw it coming months in advance while everyone else was blind to it. Let's break it down. Here's what you're about to learn. First, the exact market conditions that set up this trade. This wasn't luck. It was pattern recognition at the highest level. Second, the step-by-step strategy Soros used to build a $10 billion position against the pound. We're talking mechanics, timing, and risk management. Third, why the Bank of England, with all its resources and power, was completely helpless to defend their currency. And finally, the three core principles from this trade that apply to any market, any asset, any time period. Whether you trade or not, understanding how Soros thinks will change how you see risk and opportunity. This is the trade that made Soros a legend. But the real lesson isn't about currency markets. It's about seeing what everyone else refuses to believe. The setup, why the British pound was doomed. To understand how Soros broke the bank, you need to understand what the Bank of England was trying to do in the first place. In 1990, Britain joined something called the European Exchange Rate Mechanism, the EARM. Think of it as a pre-Euro system where European currencies agreed to stay within a narrow trading range against each other. Britain's pound was pegged to the German Deutschmark. The deal was simple. Keep the pound between 2.78 and 3.13 marks. If it dropped too low, the Bank of England had to step in and defend it. But here's the problem, and this is where Soros saw the crack in the armor. Germany had just reunified. East and West Germany merged, and the German central bank was raising interest rates aggressively to fight inflation. High German rates made the Deutschmark stronger. Meanwhile, Britain's economy was in a recession. Unemployment was rising. Property prices were collapsing. What Britain needed was lower interest rates to stimulate growth. So Britain was stuck. To stay in the ERM, they had to keep rates high to defend the pound. But high rates were choking their economy. Soros looked at this and asked a simple question. How long can they keep this up? The answer? Not long. Building the position. How Soros bet against Britain. Here's where most people misunderstand what Soros did. They think he just clicked sell on £1 billion and walked away. No, this was surgical. Starting in early 1992, Soros and his quantum fund began quietly shorting the British pound. Shorting means borrowing pounds, selling them immediately, and planning to buy them back cheaper later. If the pound drops, you profit on the difference. But Soros didn't stop there. He built a $10 billion leveraged position. That means he controlled $10 billion worth of currency with far less actual capital, using borrowed money to amplify returns. He also bought British stocks. Why? Because if Britain was forced to leave the ERM, they'd have to cut interest rates. Lower rates equals stock market rally. Soros wanted to profit both ways, down on the pound, up on stocks. But here's the genius move most people miss. Soros went public. In interviews leading up to September, he openly said the pound was overvalued. He wanted everyone to know he was betting against Britain. This wasn't arrogance. It was strategy. Why? Because if other traders believed him, they'd pile in. And once a currency starts to fall, it triggers a feeding frenzy. Every hedge fund, every bank, every speculator starts shorting. The pressure becomes unstoppable. That's exactly what happened. Black Wednesday, the day Britain surrendered, September 16th, 1992. The pound is under attack. The Bank of England tries everything. They raise interest rates from 10% to 12% in the morning. Nothing. They raise them again to 15%. Still nothing. They spend billions buying pounds on the open market, trying to prop up the price. But for every billion they spend, Soros and hundreds of other traders are selling more. Think about this. The Bank of England has maybe $50 billion in reserves. Soros alone has $10 billion in short positions. And behind him are dozens of other funds doing the same thing. It's not even a fair fight. By 7 p.m. that evening, Britain's government announces they're leaving the ERM. The pound immediately crashes. In 24 hours, it falls over 15%. Soros closes his position. His fund makes $1.1 billion in profit. Other traders make billions more. The British Treasury loses an estimated $3.4 billion trying to defend the currency. One man versus one of the world's most powerful central banks. The man won. Why this trade still matters. The 3 principles. Let's pull out the lessons here. Because this isn't just history. These principles show up in every market cycle. Principle number 1. Unsustainable systems always break. Britain was trying to maintain 2 contradictory goals: defend the pound and fix their economy. You can't do both. Soros didn't create the problem. He just saw it before anyone else admitted it. This shows up everywhere. Overvalued stocks propped up by hype. Real estate bubbles supported by cheap credit. Governments printing money to avoid pain. If the fundamentals don't support the price will eventually collapse. Principle number 2. Central banks aren't all powerful. The Bank of England had $50 billion. The global currency market trades $6 trillion per day. When market forces move in one direction, no central bank can stop it forever. This is why fighting momentum in markets is dangerous. You might be right about value, but if the market disagrees, you'll get crushed before you're proven correct. Soros had the market on his side. That's the only reason this worked. Principle number 3. Conviction plus position sizing equals life-changing returns. Soros didn't bet $10 million. He bet $10 billion. That's 30% of his entire fund on a single trade. Why? Because he had conviction. He'd done the research. He'd mapped out the scenarios. He knew the Bank of England was trapped. Most people never make life-changing money because they never take life-changing risk. They bet small when they should bet big. They diversify when they should concentrate. Soros once said, "It's not whether you're right or wrong, but how much money you make when you rewrite and how much you lose when you re-wrong." That's the difference between a 10% return and a 100x return. Common mistakes people make with this story. Let's talk about where people get this story wrong, because the mistakes here reveal how most people think about trading and risk. Mistake number 1. Thinking this was a get-rich-quick gamble. Soros didn't wake up one morning and randomly short the pound. He spent months analyzing the situation. He studied German monetary policy, British economic data, and the political pressures on both governments. This was calculated risk, not reckless speculation. The lesson? Big wins come from deep preparation. If you don't understand the asset, the context, and the forces at play, you're not investing, you're gambling. Mistake number 2. Believing central banks always win. People worship institutions. They assume governments and central banks can control markets forever. But markets are just millions of people making decisions based on incentives. When those incentives point one direction, like they did in 1992, no institution can fight it. The fix? Always ask, what are the incentives? If a government, company, or system is incentivized to do one thing, but claiming they'll do another, bet on the incentives. Mistake number 3. Sizing positions based on fear instead of probability. Most traders would have bet 10 million on this trade, not 10 billion. Why? Because losing 10 million feels manageable. Losing 10 billion feels catastrophic. But Soros sized his position based on probability, not fear. He calculated the downside, the upside, and the odds. Then he bet accordingly. If you're only willing to risk what's comfortable, you'll only make comfortable returns. Big wins require uncomfortable risk, but only when the odds are stacked in your favor. Your action plan. Here's what I want you to do with this information. Step 1. Pick one market or asset you follow. Stocks, real estate, crypto, whatever. Ask yourself, what unsustainable situation is everyone ignoring right now? Look for contradictions. Look for systems that require two impossible things to be true at once. Those are the cracks where opportunities hide. Step 2. Study one historical market event like this. Doesn't have to be Black Wednesday. Could be the 2008 crash, the dot-com bubble, the GameStop squeeze. Understand why it happened, not just what happened. Pattern recognition is a skill. You build it by studying patterns. Step 3. Start thinking in probabilities, not certainties. Soros didn't know the pound would crash. He knew it was likely, and the payoff was asymmetric. That's enough. Take these 3 principles and start applying them. Look for unsustainable systems. Bet against the crowd when the fundamentals are on your side. And when you have conviction, don't bet small. That's how George Soros made $1 billion in a day. And that's how you start thinking like someone who sees opportunities instead of risks. Now go find your own broken system